Hi, everyone. I'm Gary Brode from Deep Knowledge Investing. We work with hedge funds, family offices, registered investment advisors, and individuals like you, and we help people get better returns in the stock market. I'm here for the second week in a row with our guest host, Robb Fahrion. He's the founder and CEO of Flying V, our marketing partner. Robb, thanks so much. Great to see you.
Thanks, Gary. Glad to be back. I guess I did all right last week.
You were great.
As everyone, if you've listened before, Gary puts out a weekly segment called The Five Things. So I'm honored to be here, be able to host that and walk you guys through each one of those points that Gary has come up with for the week. So Gary, this week we have the disinflation and deflation issue. Anything from a high level that kind of just encapsulates everything that's going on?
Yeah, let's talk about the big picture for a second, because obviously the big story in finance for the last 2 years has been inflation. That's what everybody's focused on. And the truth is, even if you're not a financial professional or somebody who invests in the markets, everybody's thinking about inflation and a higher cost of living. And so let's just take a minute and talk about the difference between disinflation and deflation, because they're two different things and they're used in two different ways. So disinflation is a change in the rate of change. No one panic. For those of you who do not fondly remember your high school calculus, right, talking about second derivatives, it simply means that we still have inflation, but the inflation is moving at a slower rate. So we go from like a 9% inflation rate to a 6% inflation rate to a 3% inflation rate or 4% on the core. And so prices are still going up, but they're going up at a slower rate. So if your life is unaffordable, it's going to continue to be less affordable. It's just the difference will be a little bit less, but nothing's getting cheaper. And that's what disinflation is. And Wall Street is very excited about this whole disinflation narrative because we tend to focus on the second derivative. We tend to focus on the changes in that rate of change. But what the American consumer really needs is deflation, is lower prices. Now, I know there are going to be, some people who took a college econ class who are going to put in the comments, no. If you have deflation, you're going to have a recession and it's going to destroy the economy. No, this is 100% not true. They are correlated, but the causality goes the other way. It's the lack of demand from a recession that creates the deflation. It's not deflation. It's not lower prices that destroys the economy. And so many people will say, no. People won't buy if they think prices are going down. And that is 100% weapons grade baloney. I want everybody listening to this, just take a minute, do a mental inventory about everything you've spent money on in the last month. So you pay your mortgage, you pay your rent. Are you not going to buy a house or rent an apartment because prices might be cheaper a year later? You're going to live on the street for a year because maybe you'll get a better rent? No, right? Same thing with food, right? Everybody's grocery bills have gone up. If you knew that, food would be cheaper in a year, are you going to stop eating for a year? Of course not. And the best proof of all of this is take a look at technology. Right? Things like TVs, computers, you continually either get cheaper products or you get better performance at the same price. But that doesn't stop people from buying technology, right? There's a reason why the stocks with the highest market cap are all tech companies, both hardware and software. So this idea, I know people are going to say, no. If you have deflation, if you have lower prices, it'll crash the economy. That is, the causality goes the other way. And, again, for everyone listening to this, somebody explained to me how lower prices are worse for you, how having a more affordable cost of living is going to crash the economy, and nobody will want to work and invest and save. That's the biggest bunch of nonsense I've ever heard in my life. And so I think for a lot of the last couple of years, Wall Street's been focused on the wrong thing, or at least a different thing than most Americans are. And understanding that difference between kind of the financial economy and the real world economy has helped us make money for the last couple of years.
Great. Yeah, thanks for that clarification. And whether you have a comment that agrees or disagrees, we encourage you to please start discourse too. So definitely leave something in the comments. And Gary, you're always good about getting back. Creates great conversation. So
yeah,
let's get into go ahead.
But for people who disagree, give me the reason. Just include the word because in that sentence. we can have a discussion, we can have a debate, but saying, no, you're wrong. All right. That's, that conversation's not going anywhere. Just use the word because. Tell me what you're thinking and we can talk about it.
Perfect. Moving into the first point. So we're going to talk CPI. CPIA for October, slightly below expectations, gets the market a little bit excited. That came in at 3.2%, which was 0.1% below expectations.
Yeah, so the CPI is the Consumer Price Index, and that is compiled by a government agency, the U.S. Department of Labor Statistics, and basically it is a proxy for inflation. When people talk about inflation and they use one number for it, they're typically talking about the CPI. Let's just make a couple of points here. First of all, the October CPI, 3.2%, it was below expectations. The market loved that. The same thing for the core. The core CPI, Consumer Price Index, is just the regular CPI, but excluding volatile categories like food and energy. And that is still right around 4%, which is double the 2% target, which itself is 2% too high. Everybody's heard about the Federal Reserve saying we've got a 2% inflation target. That is completely made up. It is a random number that they pulled out as a way that they can steal from you a little bit every year. If you look at the documents, the mandate of the Federal Reserve is stable prices. That's a 0% inflation rate. We'd be much better off with that. So inflation isn't as low as people think. And you've got people wildly trading these stocks based on the CPI coming in 0.1% high, 0.1% low. And the reason we think that's a little bit silly is because the US Bureau of Labor Statistics is not capable of measuring anything with that level of precision. Right. And so we're basically saying tiny changes in numbers that can't be measured precisely result in huge changes in value. And that actually makes no sense at all. The other thing we'd add to that is so much of the CPI is manufactured and lies. So let me just give you two great examples. One is food inflation came in at 3.3%, with food at home up only 2.1%. Again, if
where I want to know where that is.
Yeah, right. Exactly. Exactly. So for everyone listening to this, if your grocery bill is up only 2% in the last year, please put it in the comments. I want to see. You're the only person in the country. I want to see this. The people I know are telling me 20 to 30%. Rob, how much is your grocery bill up in the last year?
I mean, we go in and spend a couple $100, it seems like, and open the pantry and it's empty almost.
Yeah. Yeah, I saw a funny meme the other day. It was a grocery cart, and the caption was, "It's the most expensive vehicle you'll drive all year." The other thing that really jumps out is the decrease in the health insurance cost is down, I think, 37% from the high. It's at 2018 levels. Again, I'm asking you guys who are watching this, are you paying the same amount for your medical insurance, your health insurance, that you were in 2018? If you are, then you might believe the CPI. If you aren't, then you're going to come to the same conclusion as deep knowledge investing, which is the CPI is total nonsense, and stocks are moving up and down based on numbers that are completely made up. So, listen, we look at it, we follow it because the market pays attention to it, and you need to understand what's moving the market. But, I'm not moving my portfolio based on a random number generator from the BLS, the Bureau of Labor Statistics.
We talked about it already being not something to put too much weight into. Where do they determine where they will pull those numbers from? Is it picking and choosing, picking their spots? What's the method to the madness behind it for them?
Yeah, so I think there are two things that they do. One is there are over 70 separate adjustments that are made to the CPI. And so that basically the Bureau of Labor Statistics gets the numbers and then they redo the numbers. And does anyone want to bet that they're making it look worse? Does anyone want to bet the US government is telling us inflation is worse than it is? Of course not. Right? They always make it look better. The other thing is they make weird changes in methodology that don't necessarily make a lot of sense unless you understand what they're trying to do. And so the easiest one to use as an example is owner's equivalent rent, right? The shelter part of the CPI, which is about a third of the CPI, is supposed to reflect what Americans pay for housing. And so this is about 25 years ago. they switched from actual housing costs to something called owner's equivalent rent, where they go to people and they say, if you were to rent out your house, how much would it rent for? Well, nobody knows, right? Most people who are homeowners, and particularly if you live in a residential area, right? That, like, I live in a neighborhood, nobody's renting near me. There's nothing wrong with renting, but the houses near me aren't rented. Nobody knows what these houses would rent for. And so the reason they do that is because OER, the owner's equivalent rent, has grown at a much, much, much slower rate than actual housing costs. And so for the last 25 years, the largest part of the CPI is a metric that is deliberately designed to understate people's costs, their actual costs. So, you look at this and realize, okay, like, these are not real numbers. It's a government narrative. And,
Right.
that's fine as long as you understand that, as long as you understand, right? It's like playing cards with somebody where, you ask them if they have a good hand or a bad hand. Like, they're not going to tell you the truth.
Right. Right. Moving to our next point, we're still in that, improving inflation data. Now we're looking at the PPI, so producer price index. PPI signaling deflation. You say maybe.
Right. Okay. Let's just talk about the PPI for a minute. That is like the CPI, but the PPI is further back in the supply chain. So when we talk about the CPI, the consumer price index, that's what we as consumers pay, or, the change in what we're paying from year to year. The PPI is further up the supply chain. Those are the costs of the inputs. So if you're a producer, if you're a manufacturer, this is what it's costing you to produce and ship a lot of goods. And one of the reasons the PPI came down is fuel costs have come down. And so shipping costs have come down. And that has been a huge change. And that is why the PPI came in quite much lower than the core PPI, because the core excludes energy, which is what we were talking about before. So the reason that, I'm a little skeptical on this is because, so the reason we look at the PPI is because it tends to be a really good early indicator of consumer demand. Right. So imagine that you're a manufacturer. Imagine you're making things that people like, they want, and they buy. And you think the economy is going to be great and there's huge consumer demand. Rob, what do? You run your factory all out, right? You hire extra people, you produce a ton of stuff. When the PPI gets weak, what's often happening is producers are saying, wait a minute, I'm concerned about consumer demand. I'm going to there just isn't as much demand. And so I'm going to spend less on this stuff. That combined with lower fuel prices is what helps here. And so the reason I say maybe is there are a lot of indicators that, the consumer might be a little bit weaker than we had thought a couple months ago. But if you look at consumer spending, it's still very, very high. And so, we're kind of at one of those inflection points where sometimes, you're looking at the start of a trend, and sometimes you just see something where, there's an anomaly, and for a month or two, these metrics take a breather, and then you end up with the acceleration in prices again. And at this point, if you wanted to have evidence in either direction, you could find evidence to support either thesis, that things are, for the consumer, are getting better or getting worse.
Sure. And we've seen consumer spending, and this, I think what your point said just a minute ago, moves into that point 3. Consumer spending has been on the up and up, but we have seen a break over this last reporting cycle. So point 3 coming in, American consumer takes a breath, and again, you say maybe.
Yeah, so we've seen consumer spending up something like for the last half year. And, the stock market, Wall Street got excited last week when retail sales came in down 1% in October relative to September. So we do a lot of different comparisons. What this is saying is the consumer spending was down from the prior month, but up from the prior year. So we compare to September, spending was down 0.1%. If we compare to October from a year ago, spending was up. And so part of the reason spending is up is financing costs are higher. Now, everybody listening to this, you guys know, right? If you've bought a house, what's happened to your mortgage rates? They've gone up. If you financed a car, right, your financing costs have gone up. And the same thing, Americans buy a lot of big ticket items on credit, things like furniture. And that's all right, but those financing costs are going up, and that's leading to higher costs. And, another reason we have higher consumer spending is because of inflation. People have to spend more money again at the supermarket or, to buy the same kinds of things. So again, the reason I'm slightly skeptical about this, and I don't think this metric is manipulated like the CPI is. I think, this retail sales are retail sales, and this number is harder to screw around with. But, in the written version of the 5 things, I have a graph of retail sales from 1992 up through last month. So we're talking about more than 30 years. And what you see is you can draw a straight line upwards and to the right of growing retail sales, growing consumer spending straight through. And there's a little drop in 2008 when we had the financial crisis. There's a big, very, very temporary drop in 2020 at the beginning of COVID when nobody went out, nobody spent on anything. But if you skip that trough there, what we've had is an increase in spending over the last couple of years, and that line goes straight through. And so, for people who are saying, great, we've had a 0.1% reduction in consumer spending, that's going to put less pressure on inflation. And, there's certain concern for retail going into the holiday season. My answer on that is maybe, because it's again a situation where, it's down 0.1%, but from an all-time record high. The US consumer is still spending like, their credit cards are either not maxed out or like they don't intend to pay the bill, and they'll max it out and then leave the credit card companies with the debt. We'll see what happens.
Yeah, that's going to be interesting, because it's like you see all of this inflation, everything's more expensive across the board. Credit card debt's at an all-time high,
Right.
Yet spending continues to accelerate. My question actually would be, okay, of that retail sale calculation, I mean, what is that including, and is there certain things that are getting excluded? Meaning, is that consumer spending because it costs more to get less and it's buying necessities, meaning that lifestyles are just unaffordable, even for gas, food, right? All the necessities.
So Rob, that's a great point. And some of the big retailers have actually addressed that over the last couple of quarters. This has been a theme in retail. First of all, what we're seeing is there is reduced demand for big ticket items like cars and furniture for the reason that we just talked about, right? The financing costs are higher. And so that's lowering demand. For the rest of it, the retail companies are telling you that there is a shift. So people are spending less money on discretionary purchases. Discretionary goods. They're spending more money on services, experiences. People are spending, we've all been joking about, is Taylor Swift responsible for inflation? Her $1 billion tour, but people are paying a fortune for concert tickets, for sporting events. People are spending a fortune on travel. And then the other thing, Rob, you nailed it. The key thing is people are spending a lot more money on necessities. When their grocery bill is that high, it puts them in a position where they're not going to be able to spend as much on, disposable goods or furniture or televisions, things like that.
Right. Point 4 kind of circles back a little bit. We have deflation versus disinflation. I know we talked about that a little bit at the top of the show, but definitely more to discuss in a little bit more detail here.
Yeah, so let's go back, and
sure.
I want to talk about the example that I used in the written version of the 5 things. And, for people who are interested in seeing that and seeing the graphs, feel free, go to the deepknowledgeinvesting.com. You can click subscribe now. There's a free option, and you'll get the 5 things. You'll get it a couple days late, but you can read the full version and see the graphs. But the example I gave, and again, this is the difference between the way American consumers view the economy and Wall Street views the economy. So imagine that, you've got your weekly grocery bill of $100. And, that's tight for a lot of people. And, most Americans are living paycheck to paycheck. People don't have, thousands and thousands of dollars of reserves. And so imagine now that your weekly grocery bill goes from $100 to $120. And, like Rob, for certain people, they're like, okay, $20, who cares? Right? No big deal. Right. It's for a lot of people, it's a rounding error, but for a large number of people, that's a 20% increase in something that's a big expense for them. And when finances are tight, that $80 a month can make a huge difference for you.
No doubt.
All right. So let's imagine that happens in year one. And now we get to this year and your grocery bill goes from $120 to $130. And you've got people saying, this is fantastic. We have disinflation. Okay, well, true, right? Our inflation rate went from 20%, going from $100 to $120. And when you go from 120 to 130, that's a ballpark of 9% change, less than 10% change. And so it's great, things are getting better. Except if your $100 grocery bill is hard, and your $120 grocery bill means you have to start cutting back on other things, your $130 grocery bill may be the difference between making ends meet and not. And so having people say, hey, congratulations, isn't this disinflation wonderful? It can be maddening for a lot of people and be really hard for a lot of people. Now, we got some really interesting retail results last week where the narrative actually started to shift from disinflation, which is the maddening example we just gave, to actual deflation. And the most interesting one came from Walmart, which is often a good proxy for the health of the American consumer. It is a massive retailer. They're a diversified retailer, and I believe they're in every state. So you have geographic dispersion, you have different kinds of goods. And Walmart reported an increase in comparable store sales, but they said that prices of some goods are actually down from last year, and they're already lowering prices to pass on some of those savings to the consumer. And so, we've got this whole narrative that, you were just talking about, where you've got spending is high, credit is high. Last week, we talked about lower shipping rates.
Mm-hmm.
We're talking about a lower CPI, a lower PPI, lower shipping costs. And now we're talking about lower actual costs to retailers. And so, that's why we're saying this is, like the disinflation versus the deflation issue. Because in some places you'd say, wait a minute, we've got a roaring economy and there's still tons of consumer spending and tons of demand. And, you got a massive retailer like Walmart saying, not so fast. We're starting to see some prices turn. So it'll be interesting to watch.
Right. Yeah. And the chart that's provided, just for everybody, if you haven't seen the 5 things email, talks about absolute value, right? Which, to your point, I used to spend 100. Yeah, I'm not spending as much at as fast of a rate, but I'm still absolutely spending more at the end of the day.
Yeah. And let's be honest with people. And I'm going to apologize for like what I'm about to say is going to be disturbing to a lot of people. But for those of you who, in my hypothetical example, right, your grocery bill over a couple of years went from $100 a month to $130 a month. And again, that can be hard for a lot of people, that change. Your grocery bills are not going to go back to $100, right? Even if we have a reduction of inflation, even if inflation goes to zero, right, you're not going to get 30% deflation. In this example, we're not going to see the prices that we saw just a few years ago. And so if you're in a tough spot right now, it's not going to get better. And you're either going to need to find a way to make more money or to cut expenses because, inflation might slow and we might get a little deflation, but your grocery bill isn't going down by 30%. That's just not going to happen.
What would be a notable movement, in your opinion, just in terms of a deflation movement? Like, are we talking 5%, 10%? Obviously 30% is humongous and that's not happening, right?
Yeah,
but I mean,
that's not going to happen. I think the things that would really crash the CPI is if we start to get more housing supply on the market, where that's making up, where you've had prices up 40, 50, in some markets, 70, 80% over the last 3 years. And, mortgage rates have gone from 3% they went to 8%. Now they're, between 6 and 7%. You could see something happen there. Long term, I'm very bullish on energy prices, but certainly short term, in the case of a recession or worries about demand, you could have energy, which is also a big part of the CPI, get cut. But I can tell you the Federal Reserve is not going to allow 5 or 10% deflation. Once that CPI turns negative, you better believe Powell is going to turn incredibly dovish, which is, just Wall Street speak for he's going to pivot to lower interest rates. That combined with the fact that Congress is spraying an extra $2 trillion a year on balance sheet into the economy, which we talked about last week, means you're not going to see big negative numbers. And the minute that CPI turns negative, the Fed will lower rates and try to spark more inflation. Like that, there's no way in the world we're getting to lower prices.
Makes sense. Fifth point here to wrap up this week's session. So if you're a DKI subscriber, been following Gary for some time, Las Vegas Sands, ticker LVS, has been a current recommendation for some time now. Our fifth point today, problems at WYNN. So WYNN Resorts, not evident at LVS, Las Vegas Sands.
Yeah, so Las Vegas Sands has been a great stock pick for us. We've made a ton of money in this, and a recent options trade is we're up, depending on the day, between 50 and 70% in an options trade. We've been in for about 6-7 weeks. Please do not annualize that. Everything we do is not going to make you 50% in a month and a half. But it's worked out really well. And so WYNN, which is a competitor to Las Vegas Sands, announced earnings last week. The week before. It was a Friday, I think. And there was some disappointment about the performance in one of their Macau casinos. And that caused the stock to be down. It was down more than 10% at one point during the day, and ended the day down almost 6%, and pulled Las Vegas Sands down with it. And the reason, again, is people were worried about performance in Macau. And occasionally the market gets things wrong. Like in general, the people who follow these things are pretty smart, and they know these companies and they know the way they work and interact. And, the market in general tends to get things right. This was one where the market completely got it wrong. And the reason is because the prior week, Las Vegas Sands had reported earnings, and results in Macau were fantastic. I think they've had 4 casinos that were announcing record RevPAR, that is revenue per available room. They're getting record rates there per available room. This is, I don't mean since COVID, I mean all time. The property level EBITDA, earnings before interest, depreciation, taxes, and amortization in Macau for Las Vegas Sands is closing in on the levels they were at pre-pandemic. And so we have evidence that Las Vegas Sands is very well positioned in Macau and performing well there. And so, if WYNN has problems at one of their casinos, it shouldn't be an issue. And so, our friends over at Inside Asian Gaming, and they do a phenomenal job covering the world's largest gaming markets. They put up an incredible chart. And what it shows, hang on, yeah, WYNN is the one in red. What it shows is from the third quarter of 2019 to last quarter, WYNN's market share has fallen from 14.2% to 13.4%. So they've lost almost 1% market share. The same time, Las Vegas Sands has gone from 23.2% to 26.9%, meaning they've gained almost 4 percentage points of share. So the market got upset and worried that things weren't going well at WYNN. Okay, let me give you another way to think about it. Things weren't going well at WYNN because Las Vegas Sands is taking share from WYNN. Las Vegas Sands is gaining market share at the expense of its competitors, at the expense of WYNN. Now, I think WYNN is a good company. I think they're well managed. I'm not criticizing them in any way. But right now in Macau, Las Vegas Sands is outperforming them and taking share from them. So problems at WYNN are not indicative of a problem at Las Vegas Sands. It's actually a marker for how well Las Vegas Sands is positioned to compete in the world's largest gaming market. And, they're gaining share there now. And so, we continue to like that position a lot. I have a huge position in it in my personal account. And then, as I mentioned, we've owned some options where we've done really well as well.
What's the catalyst for that movement and market share for LVS?
So it's a couple of things. One, they've built really well. Las Vegas Sands is constantly expanding, and they've had multi-billion-dollar projects. And so that's part of it. But the big thing is WYNN caters to the VIP gambler, right? These are the whales, the people who are gambling sometimes millions of dollars on individual hands. They get flown in on private jets. And, it's an exciting business because each individual customer, each individual VIP can be responsible for huge amounts of profit. But there are two problems. One is the VIP market is not as profitable. The margins on that business, it's more profitable for each individual, but the margins on that business are much lower. And so that's part of it. The other thing is the VIP gambler has not been eager to return to Macau, and they've been much, much more cautious. Whereas the mass market and the premium mass, maybe people are spending $100, $200, $300 per hand. That much more profitable market, they are racing back to the casinos with what Howard J. Klein, DKI's gaming advisor, refers to as pent-up bankroll. They haven't been able to gamble for a few years, and so they've got money saved up. And Rob, do you remember 2 years ago when in the United States they started using the term revenge travel?
Oh yeah.
Right? People had been locked in their homes for a couple of years.
Right.
The minute they felt safe to get out, that we are going to travel, we're going places, people started spending a fortune on vacations and travel and experiences. Well, in China, they're revenge gambling right now.
Right.
But that's very much a mass market phenomenon. And so that's where Las Vegas Sands is really well positioned. They are loaded up with tons and tons of rooms to cater to the mass and premium mass market. And so Sands is focused on the very profitable part of the market that's growing, where there's pent up bankroll. And WYNN is, to their detriment right now, focused much more on the high end VIP market. And that's just a weaker market right now. Now, could that change in the future? Sure. And again, I'm not criticizing WYNN or their management. They have a vision, and they do things the way they do, but there's a reason that Las Vegas Sands is hugely outperforming WYNN right now.
Macau as a whole too. So I know China with COVID and pandemic regulations was a little bit slower to ease. Everything eased at this point in Macau. I know with the IAG group, they keep close tabs on that, but can you highlight for anyone that might be unfamiliar about that particular market, just in terms of the ability to travel, right? The ability to game, etc.
Yeah. So the US opened much more quickly than China did. And so Vegas did horribly in 2020. But, there was a point in 2021 where the market recovered and they just wanted to be out. And so Las Vegas started putting up record numbers, I think in, 2021, I think as early as that. China stayed locked down for the better part of 3 years and didn't really start to fully reopen until January of this year. So they've been much more slow to respond to this. And, the Chinese gambler is following the example of the US gambler and starting to return to Macau in size. Again, it was either 3 or 4 of Sands casinos with record levels, all-time highs in revenue per available room. And so, we are rapidly heading for occupancy and revenue and EBITDA levels in Macau, at least at Las Vegas Sands properties, that should soon start to exceed the pre-COVID numbers. The company's always been very shareholder friendly, and they've already reinstated the dividend and stock buybacks, and they have enough cash on hand to fund all of the expansion projects that they're working on, including a massive expansion, a 4th tower and a concert arena at the Marina Bay Sands in Singapore, which is, one of the world's most profitable buildings in the gaming world.
I'm sure it's incredible.
Yeah. The photos are amazing. Yeah.
Great. So that wraps up everything for this week's 5 things. As Gary mentioned, if you head to deepknowledgeinvesting.com, hit subscribe now. There's a free option. You'll be subscribed to weekly newsletter, receive this in your inbox. And obviously would love if there's consideration for a premium subscription as well. We want to thank everybody watching. Thank all of our premium subscribers at DKI. Gary, any closing thoughts?
No, Rob, thanks. I appreciate doing this with you.
It's been fun. Yeah, let's keep it going.
All right. Looking forward to seeing you guys next week.
Thanks, everyone.
And wait, next week I will be filming from the Philippines.
That's right.
Heading to Manila this weekend. And so we will be doing this internationally. Looking forward to seeing you from the other side of the world.
Sounds good. I'll hold down the fort.
All right. Thanks, everyone.
Thanks, Gary. Thanks, everyone.